Hello, ladies and gentlemen. How are you? I hope you are doing fine, wherever you are springing from. Okay, I am the ACCA tutor, Mr. Jeremy Timkulu, and in this video, we are going to continue with our week one lecture series, where we'll be tackling areas around the financial management function as well as working capital management. So far, we've covered a lot of things, including the financial management function, as well as the introductory parts of working capital management. However, before we delve into the deeper parts, we need to revisit certain things. Okay, so let me, guys, take you to the areas I feel we need to discuss a little bit more. Okay, especially areas to do with ratio analysis. I found that maybe we need to just cement that area once and for all. Okay, I have hinted that we can make use of the DuPont system, right? The DuPont system or the ratio pyramid, as you can see on the screen. However, there are other ratios as well we can incorporate for the purposes of passing the ACCA FM, the financial management examination. Okay, there is a ratio called ROS. You cannot go into the ACCA FM exam without knowing this ratio, ladies and gentlemen. So what is ROS? All right, ROS is equal to, ROS stands for return on capital employed. And how do we calculate ROS? ROS is equal to profit before interest and tax over capital employed. All right, so you can see that if we are saying that this is a return on capital employed, we're simply saying that this is the return the shareholders expect from investing in long-term investments. All right. So by using the profit before interest and tax, we are saying that this is the profit that is enough to pay or to settle the demands of our finance, our funders, all right, as well as our equity shareholders. So it's actually a profit muscle, which shows that we can pay the cost of capital, or maybe to meet the cost of capital, as well as to satisfy our shareholders. So we just have to use like and like. In the exam, the examiner will tell you which profit to use in the computation. But what you need to understand is that this is the profit which is enough to settle the the cost of finance. However, when we say capital employed, we are simply saying that this is long-term capital. All right, so we are looking at the equity capital plus the non-current liabilities. So capital employed is driven from the statement of financial position, where you have to add the equity amount as well as the non-current liability amount. You can as well compute capital employed by looking at the total assets less current liabilities. You are going to get the same figure of capital employed. All right, so is it necessary? Yes, it's necessary, because we need to see how much we are earning as profit from our investments in long-term assets. All right, so I thought it is very imperative to highlight this particular ratio before we move on. However, I want you also to appreciate that this ratio, the ROS, is also sometimes called the return on investment. So this is why I say that the examiner will tell you which figures to use, right? And uh, you also be at a better advantage if you quickly understand that the return on capital employed can also be referred to, referred as the return on investment. So they are just the same ratio. However, if the figures relating to these amounts are not given, therefore you need to go the traditional way of computing ROS, which I have already indicated as profit before interest and tax over capital employed. Are we together? The ratio is given as a percentage. So you just have to ensure that you multiply this fraction by 100%. All right, because by the end of the day you are going to give your ratio in terms of percentages. Then another thing I have to point out is that the profit before interest and tax is sometimes called operating profit. So sometimes the examiner is not going to use the profit before interest and tax, but simply say operating profit. So you need to be able to discern what he would be referring to, he or she would be referring to. Okay, another ratio on profitability which I want to put across is the operating profit margin. Operating profit margin. Okay, before I discuss that ratio, I also want you to appreciate that the reason why I'm saying that all these ratios are on profitability, if you look at them, they are talking of earnings or of returns. So return. That on its own simply tells you that we are talking of profitability. All right, those return, we are referring to profitability issues. All right, good. Now let's discuss operating profit margin. This is also a profitability ratio. All right, so but what are we talking about when we are saying operating profit margin? And I've already indicated that when I'm saying operating profit, obviously I'm talking of profit before interest and tax. So you just have to be able to pinpoint what is happening. All right, but a clever student should have seen that from the DuPont system diagram there, the operating profit margin is also there. So I want you guys to show me where this is. Just pause the video and point out the position of the operating profit margin and then verify it with mine. Excellent. You guys are wonderful. The operating profit margin is this one. All right, is actually the net income margin, the net income margin. All right, sorry, let me just erase this. Sorry. Okay, it's actually the return on sales there. I have so this is actually the operating profit margin. All right, although the terminology is not that clear. However, I wanted you to understand that this you just have to assume. However, the figures, the real figures you need to pick should be from the profit before interest and tax, because that's the net income we are talking about, not the net profit. All right. So in this case, we are saying that the return on sales here is then given by the net income over the sales. All right. And like I said, for you then to be able to accurately compute the operating profit margin, you then have to tell yourself that the return on sales, the net income in question should be the profit before interest and tax. And this should then be divided by the sales. Sometimes you will find the word revenue representing sales. Okay? So it's PBIT divided by revenue. That gives us what is called the operating profit margin. But on the DuPont system there, it has been written simply as a return on sales. Okay, but I don't want you to get used to the wording of return on sales. Why? Because sometimes it is misleading. So the appropriate ratio you need to tell the examiner is, the appropriate name should be operating profit margin. Okay, operating profit margin. The reason why I'm saying you need to use operating profit margin is that the word profit margin itself refers to two margins which you need to calculate in this particular exam. The other one, instead of saying the operating profit margin, sometimes the examiner would want you to calculate what is called the gross profit margin. So you can see that you are not safe if you simply say the profit margin was. The examiner will just say, which profit margin are we talking about? Are we talking of the gross profit margin or the operating profit margin? So you need to be very, very clear to the examiner. Otherwise, you might end up failing something you were entitled by default to pass. So what is the gross profit margin? The gross profit margin is that return, the gross return, before we consider all the expenses. So that's the gross profit margin. All right. So we need to evaluate that return given the amount of sales which we made. All right. Because we need to understand how much are we able to pay or to settle. How much are we making so that we'll be able to settle whatever expense we are about to settle? Or are we as well be in a position to pay or to settle our expenses as a business? So the gross profit margin gives us a quick appreciation of our performance in terms of revenue. So the gross profit margin is actually given by the gross profit itself, the gross profit over the revenue. This gives us some comfort. If the gross profit is much higher, then we are actually rest assured that we are going to make it. We are going to meet all the expenses, and after meeting those expenses, we'll be left with something. But if the gross profit is too low, then how are we going to settle? However, we understand that the business is full of competition, the business environment is full of competition, then we can as well not expect a much higher or an out of this world higher gross profit margin. But we need to expect something like 30% or 20% as the gross profit margin. Then we expect that we also expect that the operating profit margin should then be somewhere around 5 or 10%, because we are operating in a stiffer competition. However, where business is good, a gross profit margin of 30 to 40% is welcome again. So your purpose should then be,